Oh boy, you just can't escape the red here in 2022. You're watching the Stock Market Brief. Today we're talking about big stocks breaking very important key levels. Getting right into it today, Apple is one of them. It was down 3%. We talked about this potentially breaking on last night's video. Tesla was in the green. Ah, yes, yes. Tesla was not zapped by the cocoa today, but Apple was zapped by the cocoa. Tesla, however, has been the last two trading days just hanging around its lower weekly expected move. So it's in its safe spot. If it starts breaking down from here, be aware for more downside action. But yeah, right now it's just in the safe zone with a couple more trading days left. So why is tech getting hit? It could be because the bonds are getting crushed while the yield is obviously on the rise here. We had that PMO crossover and things are moving up to the upside. Now, the bonds, like I said, they're getting crushed here, getting potentially into some oversold conditions, which we'll discuss here later. But we did break that 50-day moving average and was down just over 0.5% on the day, but the candle was quite wide. So a lot of volatility. We started with a big gap up and it started kind of fluttering down, back testing this channel of this recent breakout of this channel. Now, dollar is also very important to continue to watch. It is still coiling up very tightly. I'm still watching for a break to the upside and or to the downside. Interestingly enough, the S&P 500 has been on its way down. Could be because of big tech, obviously, with the yield rising, but the dollar hasn't added any ump to that. So if the dollar starts to rip into the upside, remember the negative correlation that these two assets have here. If we take a look at how the day progressed today, everything was down in the red. Goodbye, Santa. He even stole our coal. If you looked at coal stocks, they were down tremendously, like CEIX. Couldn't even leave the coal in the stocking. So Dow Jones was down 1%, S&P down 1%, and so forth down the list. All the 11 sectors were down in the red. Energy and technology led the downside mainly because of Apple. Healthcare was one of the ones we discussed yesterday, along with utilities and consumer staples. All those were down. However, they were more towards the upper end of the leaderboard, showing that, you know, some relative strength, which we'll get into here more momentarily. Now, if we take a look at the top performing stocks in the Dow and the bottom performing stocks in the Dow, JPM, I want you to remember these two, JPM and Goldman Sachs. Why? Well, financials are going to be an important one to watch, and I'll explain momentarily. But JPM was the only green stock in the Dow Jones. On the downside, we had Apple and we had Disney, some big stocks making big breaks. So let's talk about it. Apple, we broke that 130 level. So you can see here, clear distribution day. We had an uptick in volume during holiday trade, right? And we had this flush to the downside, closing at around the low. So it might not be a straight shot down, right? Where it was some more sell side activity. But I want to remind everybody what we talked in yesterday's video, how we showed a Tesla chart similar to this. And, you know, if this is a possible, you know, advanced type of head and shoulders pattern, it could take us down from measuring it from the top to the neckline, could take us down to around $80, which is where it brings us to the pre-COVID high. Now, it could potentially drop further. We talked about Tesla, how it's also been like this mega cap, the you know, just the bubble of all, and that's been just completely deflating. Now, if Apple follows suit here too, this can very well continue to crush the markets. A 3% down day in Apple, like I said, it can bring down the markets with it, and it sure as heck did. All right, if we continue on, another big one, which we just recently discussed, the second big loser in the Dow was Disney. Disney making a new 52-week closing low. And you can see here, it cracked this very important 90 level, and this thing continues to drop as it stands right now. So if we get more sell side into Disney, this is one that I want to keep close eye on because obviously Disney is not going anywhere. It's a huge brand, huge market cap, right? So this one could be potentially something to watch for when it starts to base out eventually. Could take, you know, next quarter, the quarter after that. It could be Q3 of next year before we get out of all of this crazy mayhem. But it is obviously going to be on the radar and one that I want to continue to watch moving forward. If we take a look at the NASDAQ Summation Index, we talked about this here crossover on the parabolic SR. We talked about it here, and the trend still remains to the downside. We do have a subtle divergence that is building right here. We have a lower low there, actually a new closing low on the 2022 in 2022 for the NASDAQ Composite, and the internals aren't quite matching that low yet, so there is a subtle positive divergence, but we're still under this zero line, right, on the Summation Index, and we're still pointing down. It's going to be continued to watch that. The same thing goes with the NYSE Summation Index, also broad market index to watch. We crossed down through that zero line and still pointing straight. when we did cross through the parabolic SAR over here to the upside and started ticking down, we had that sell side activity. So it does identify trend. I do have a short, YouTube short, that explains how to make this chart more specifically. If we take a look here, this is safety ratio. So we're looking at relative strength from, gold relative to the SPY. So this is gold relative to the SPY. You can see it's pointing nice and up. Doesn't necessarily mean that it's performing strongly, but it is outperforming the SPY. So it's holding up better than the SPX, right? XLU, which we discussed, right? This one's holding up. Now remember, it's sold off today, but you can see the relative strength line still continues to press higher. Consumer staples, it also sold off 1% today, but you can see the relative strength line still remains to be higher. TLT is pretty much sideways. Defensive sector, DEF, continues to press up from a relative strength. And then healthcare also just continues to press higher on a relative strength basis. So when this happens, this tells us that people are rotating more into defensive sectors. And if we're doing this and we continue to do this, it's not going to be good for the overall stock market. If we take a look here at the relative strengths, we're looking at the once Fangman stocks, relative strengths of Meta, Apple, Nvidia, Google, Microsoft, Amazon, Netflix, and Tesla. Down, right? Netflix is, coming from a bounce, but it looks like it's crossing back down through that EMA, 50 EMA. Amazon has been flat as a pancake to heading down. Microsoft, rather neutral at this particular point in time. Nvidia cracked that 5 EMA. We've been seeing, 50 period EMA. Been heading down there too as well. Apple has been heading down, which we showed a chart of this one yesterday, making a rising wedge structure. And then we have Meta. Meta is very neutral right now. And if you actually take a look at the chart, it's coiling up, right? So coiling up means what? It means price went from an expansionary move, boom, and now it is contracting. Its price is, getting very, very tight in here, looking for either a break to the upside or the downside. I don't have that chart in front of me. Take a look at the S&P 500. It came into its lower weekly expected move today on that 1.2% downside action, closing right at around the low of the day. If we take a look at the 15-minute time frame, we have a potential building positive divergence as it stands right now, a low in the RSI to a higher low. That could change quickly, right? We're not too far off the weekly expected move for the SPY. And we have a positive divergence that's still in the works here. So if price comes down a little bit, that could be a potential opportunity to play a bounce to the upside. But be mindful and aware that every bounce should be held with skepticism at this point because we are still below that declining, rather neutral, but declining 5 EMA, 5-period moving average. If we take a look at the Qs have been seeing a massive sell-off here. Now, I want to show you growth versus value chart. This is one that I show somewhat frequently. It's when it crosses down through the rate of change right here. This is a 10-period rate of change of this right here, IWF over IWD. And when it crosses down through zero, it's seen some sell-side activity. We marked the top here on this August rally with this. It crossed down through, something that we were watching. And all the red lines represent that. So I'm not going to go too much into it. What I want to call out now is we saw that cross down through right here. And you can see we've seen that sell-side activity, but I'm calling out because we are moving into somewhat overextended territory, not there yet, while we're building some sort of a positive divergence as it stands. I don't have the relative strength line on the screen. I'm showing the Qs right now, but the relative strength line does have a negative divergence where it is making a new low, where we have a positive divergence on the RSI, positive divergence on the rate of change too as well. So if the rate of change can come down into these areas, as you've seen prior, right around these areas, we have seen bounces, and then, where is this one? Bounces right there, and then right here too, a bounce as well from these overextended territories. So as the Qs, like I said, are selling off right now, just be aware that things are getting pretty frothy to the downside. Things are heating up. So this is, remember, crashes happen in overextended areas. But also, you can have some face-ripping rallies too as well. And as we're coming into year end, we could just be seeing some tax loss harvesting, and then all of a sudden things change right into the new year. It's hard to say. But if we take a look at the 15-minute time frame, what do we got going on? We are below the weekly expected move, so that's to note. If we continue to crack down through it, be very, very careful as we continue to see some dynamic hedging, which could still offer up more sell side. Remember, we're below a declining 5-period moving average as it stands right now. We talked about this one yesterday, how we were just kind of doodling around there. Now we do have a positive divergence building in the RSI, positive divergence also building in the PMO2 as well, and we have a wedging structure which could lead to a potential bounce, but remember the bounce should be held with skepticism if we do get one because we are still below a declining 5-period moving average. Next, I want to talk about the Dow Jones. We talked about it recently at the very beginning, looking at the big movers up and to the downside. But now I want to look at just the chart of the INDU, the Dow Jones Industrials. You can see we are currently bear flagging right now, and we're kind of getting held up at 33,500. As you can see, it's a pretty big area of distribution. We crack through it, and then we crack back through it, and then we're still holding as resistance here. This could be a bear flag structure. This is holding as support over here. So if this is a bear flag, look for continued downside. But to see continued downside, the big thing that we want to watch for is, obviously we saw a big crack in Apple, a big crack in Disney, but what did we not see the big crack in? Well, as you can see, JPM, Goldman Sachs are both huge financial stocks. Those were the top performing of the day. JPM wasn't even down. So if we're going to get more sell side activity, be aware of financials. XLF is the financial sector spider ETF. And as you can see here, we are flagging at this current time. You can see that MACD is starting to curl itself over. RS line is strong, and we're floating right around that 200-day moving average. We're below the 50-day, and the 20-day is currently declining. So this could be one to watch. If price holds and then breaks down, you can trail the 20-day moving average as a potential stop loss area. But if we start getting back above it, do something like that, then we could see some more bullish activity. What I find interesting here is if you look at the BP chart of the financials, we are in overextended territory. However, the BP chart itself is just fluttering around the 50 marker, so there could be more downside. Remember, oversold can be oversold for quite some time, as we've seen here, we've seen here, and so forth, okay? But if we do get some more sell side, just be aware that it could be playing just out this flag structure, and we have to be very cautious that being in overextended territories could present a bounce. So what am I thinking here? Well, if we do get some sort of a bounce, it could be a fake out sort of type move, something like that, if we do get more sell side. So something to pay attention to moving forward. IWM continues to see sell side. We saw this kind of chop box up here, broke down, and we saw down a 1.55% move today. That 170 marker is going to be an important one to watch. But overall, what has the IWM done since May of last year? It hasn't done anything. It's been just kind of in this range, right? And we remember in 2021, it stayed in a range for basically the entire year. If we take a look at the 15-minute time frame, we broke down from this diamond pot pattern, and you can see that if it cracks down, watch, it could easily strike that lower weekly expected move. And it did that. And we have a subtle positive divergence building here, subtle positive divergence that's building right over here too as well. And we're at that lower weekly expected move. So remember, if we do get some sort of a bounce, just be skeptic about it, right? Until we can get above a inclining 5-day moving average, right? So you can very well scalp intraday, but like I said, you got to continue to be careful. If we take a look at the zones really quick, this is something that I share with the Patreon group, which is a link in the comment section, along with I usually share my bookmap levels too as well on these videos, and there's a link there if you want to know more about bookmap, kind of what a tool that I use to trade intraday. A lot of green is starting to light up on the screen. You can see TNX is the 10-year yield. It's turning red, so it's getting to the upper range of its zone here, while the TLT, right? So go figure, right? TNX hits the upper edge, and then we have TLT reaching down to its lower, right here, reaching to its lower. And this is common because when yields goes up, bonds go down. So they are reaching their kind of extreme. So it's going to be something to pay attention to, right? This isn't the exact area where I'd want to go. Bonds have been, a little sketchy. So, if you want to play them, okay. But just be aware that they are reaching to these lower ranges as we back tested that channel breakout earlier. The dollar is still, it's above its middle of the range. So that's, a positive sign. 104.24 is the middle of the range, is at 104.52. So it's bullish in that sense, as price has been kind of just going sideways with it. We have 0.48% upside, 1% downside. So we'll see here if we get a crack at the middle of the range and we head lower, which could very well bring the SPY, bring various other assets up, right? Because if the dollar drops, we see that negative correlation. As you can see, there is just a lot of green on the screen overall. So any other big ones? Yeah, Qs is at the lower range. SPY, right? It's towards the lower range. XLK, right? Technology stocks have been getting hit hard. Consumer staples have been getting hit. Sorry, not consumer staples. Consumer discretionary has been getting hard. Why? Because of Tesla. And then we have IWM down there too. So like I said, on the 15-minute charts, we see some positive divergences running into the lower weekly expected move. These are lighting up green. there's a case for a potential bounce, but those bounces should be held with skepticism. Because why? Because we're below these short-term declining 5-day moving averages, and it'd be a heck of a lot better if we can get above it and the 5-day moving average starts turning up, as well as the relative performance starts cycling out of safety and more into growth type names. That's all I got for you, everybody. Have a good night.